Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of corporate filings. Today we're diving into Constellation Brands' latest report, which sounds like a relaxing wine tasting until you realize it involves dissecting balance sheets and deciphering legal jargon. Think of it as a financial hangover cure, hopefully without the headache. This report reveals a mixed bag, a slight sales dip offset by cost savings and restructuring efforts. We're not just looking at numbers, we're uncovering the company's strategy to stay afloat and relevant in a rapidly changing market as they steer their ship in uncertain waters. Before we get started, if you find value in getting straight insights from corporate reports, be sure to subscribe. Also join our Discord community where we discuss these filings. The link is in the description below. Let's jump straight into the numbers. I'll try to make it as painless as possible. We start at the balance sheet, which is like a snapshot of the company's possessions and debts. Stoned at about $813 million, it is an important number that gives important snapshot of the company and the amount of money that's owed to the company. Looking at that, we can know if people are actually paying their bills. This year actually show progress for the company from the last quarter, as they were at about $736 million, which is good. Now, retained earnings, which is how much profit the company has kept over the years, sitting pretty at almost $13 billion. Moving on, let's check out their income statement. This is like a video of how much money came in and went out over the last 3 months. About $2.5 billion, but that's not the whole story, of course. We see that they had sales of $2.6 billion, but excise taxes, like you mentioned in your taxes, that some of them are for alcohol or cigarettes companies, took about $162 million. For comparison, this was more last year, meaning people are drinking less. At the end of the day, after paying all the bills, the company made about $516 million. Which sounds very good, but if we measure it to last year's report, you can notice that there was about $877 million back then, so less people are buying their product. So what is the company doing about it? Looks like management knows the current economic situation and they have a plan to cut costs. It is called the 2025 Restructuring Initiative and is about enhanced efficiency designed to save $80 million to $100 million. So it's not just about the short term, but also about future plans of cost reductions. Another big thing is what they are selling. They have a bunch of things that they want to sell for a total of about $1 billion. Things like inventories and equipment, perhaps to get more cash flowing. They're also using these swaps to protect against currency exchange differences. It means that if the dollar suddenly becomes much stronger or weaker, it won't affect their bottom line very much. And this is a good thing that a company knows all the risks they have. Constellation Brands has a lot of debt, more than $11 billion. They try to say that it could be at like $4 billion if they were to sell now. This is a huge number, people. And when a company has a lot of debt, there are serious risks of what can happen, especially in this economic condition. Not to be alarmist, but keep that in your mind. Another red flag is perhaps that a lot of times when companies are doing not so good, they buy back their stocks. And there were purchases and they announced that they're going to purchase a bunch more stocks in the future. Why? Well, it makes company to appear more stable than it really is, since people are going to hold to it. Plus, managers' bonus are usually tied to the business success, which in the case of the company is the stock values. It may sound cynical, but a lot of times it is a signal that the future is going to be not so great for the business. Of course, as in any report, there is a lot of market risks when you deal with commodity and supply chains and interest rates. The important line is that the long-term trend is expected to continue, which means there is not going to be any change to the landscape of the business world. So what's the overall picture? Well, the company is definitely trying to cut their costs and sell underperforming assets. But on the other hand, it has a lot of debt and it is trying to use financial jugglery to perhaps make the business conditions look good, at least for now. Constellation hasn't been able to come to previous performances as people's economy are just doing worse. Therefore, there are less available income for people to buy their beers or wines. What can they do about it? Well, for now, probably cutting the costs is the best idea, but it also has its issues. For example, if the company is trying to focus on the product quality and at the same time cutting the cost, often it comes to reduction in quality too. As an investor, I would keep in mind if this is really a good business for long term, as sales are expected to drop in the future too. Alright, that's our breakdown of Constellation Brands' latest performance. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.